This video is brought to you in partnership with Stake. If you're in Australia, transfer at least $1,000 worth of Aussie shares across the Stake platform and get 12 months of zero brokerage. Stake rewards, terms and conditions apply. What are the most popular stocks among the super investors as we make our way through 2025? The Warren Buffetts, the Seth Klarmans, the Bill Ackmans, the Mohnish Pabrais of the world. Well, in this video, I'm going to be breaking down the 5 most held stocks by the smart money. We'll talk about what each business does, why the smart money would hold the business, and stick around to the end because we'll talk through how this applies to our own investing as well. So with that said, let's get started. And the 5th most owned stock by the smart money is Meta. Meta, as we know, is one of the world's largest technology companies, known for its dominance in social media and advertising. And the company operates 4 key platforms: Facebook, Instagram, WhatsApp, and Messenger, which collectively serve 3.35 billion people each day across the globe. How insane is that statistic? But from an investor perspective, the notable thing to watch is, of course, advertising revenue, which still remains and will continue to be Meta's core business for many years to come, currently contributing over 97% of total revenue. At the moment, however, Meta is pushing hard in expanding beyond digital ads. One of its biggest long-term bets is, of course, the metaverse, a virtual reality and augmented reality ecosystem built through its Reality Labs division. Now, the company continues to invest a lot of money in VR headsets, smart glasses, and immersive digital experience. Although these initiatives do remain very unprofitable. In fact, Reality Labs cost Meta $17.7 billion in 2024, while their advertising efforts brought in $87 billion. So it's a tough one. Some investors are convinced Zuckerberg needs to keep pushing for metaverse development as it could be the next big thing. But I know a lot of the value investors out there purely look at Meta from the advertising angle, and in all honesty, would completely cut out Reality Labs and enjoy their $18 billion in additional profit per year if they had a choice. Then beyond the business operations itself, one of the main reasons why so many super investors hold onto Meta is quite simply the safety of their business. Meta has an extraordinary balance sheet, boasting $44 billion of cash and just $33 billion in total current liabilities. In fact, their $29 billion in long-term debt could be covered by cash alone. And overall, they're sitting on $276 billion of total assets compared to just $93 billion of total liabilities. And how have they gotten to this amazing position? Well, it's because their free cash flow has been extremely positive for a very long time. When you're consistently making 10, 20, 30 billion in free cash flow per year, it starts to pile up. And this is a testament to the competitive advantage Meta has built. Meta is a perfect example of a network effect, the concept that a product or service gets more beneficial for a consumer the more people that use it. Why have Snapchat or Twitter or Clubhouse or any of these other platforms not been able to compete? Well, it's because chances are your friends are on Facebook, Instagram, WhatsApp, or Messenger. So you just use those platforms instead. And I think that's what the super investors see in Meta long term. They're a dominant player in online advertising. They have a great balance sheet and a very powerful moat. And Meta is one of the stocks that I've personally added to my portfolio over the years on Stake. And I do want to say, if you're an Aussie, all the stocks that I cover in this video are also available on Stake, plus thousands more. Stake is the brokerage platform I've been using for the past 7 years now in Australia. And in that time, they've grown from basically a startup to Australia's 3rd largest broker. Their main goal has always been to help Aussies and Kiwis get better access to the US markets. But since then, they've also added ASX trading for all the Aussies want to invest on home turf as well. Overall, I really enjoy the app. It's super clean, and I will just mention briefly, if you're an Aussie, you can also use my referral code NEWMONEY to get a free US stock when you open a Wall Street account, or $10 of free trading credit when you fund an ASX account. And if you're sitting there thinking, well, damn, I already have a portfolio elsewhere, well, they have an opportunity for you as well, because if you transfer your portfolio over $1,000 Australian dollars in value to their platform, they'll give you 12 months of free brokerage. So thanks always to Stake for being long-term supporters of the channel. And now back to the video. And with that said, we now get to the 4th most held stock for 2025. And that company is Visa. Visa is another very popular stock amongst the super investors of the world because of its market position and its moat. But honestly, I'm getting a bit ahead of myself. First, let's talk about how Visa actually works. And at its core, Visa is simply a middleman in the transaction process. They don't issue credit cards, they don't lend money, they don't set interest rates. Their job is to process transactions when you tap your Visa card. So here's how it works. Say you go to a store and you want to buy a t-shirt. When you tap your Visa card, the merchant sends the payment request through their payment terminal. That request gets routed through through Visa's network to your bank, the issuer, which checks if you have sufficient funds, verifies security, and decides whether to approve or decline the transaction. Then if approved, that approval signal is sent back through Visa's system, the merchant gets confirmation, and the sale is completed. So Visa is the invisible engine making payments seamless. And here's why investors love it. Visa takes a tiny cut of every transaction processed on its network. Think of it like a toll booth collecting a small fee on billions of payments worldwide. And when global spending rises, well, Visa wins. Take a look at this. This is Visa's market share. In 2023, Visa covered 5.2 trillion consumer card payments and over 1 trillion in commercial card payments, far exceeding competitors such as MasterCard and Amex. They are the dominant player in a massive and growing industry, and this keeps Visa's profits growing year after year with minimal effort. It's a really powerful moat. The more businesses accept Visa, the more consumers use it, and the more banks issue Visa cards. Plus, Visa doesn't lend money or take on credit risk. It simply processes transactions and takes a tiny cut every time someone swipes or taps their card. And this means that Visa runs an ultra efficient business with minimal overhead, and that results in profit margins of over 50%. I kid you not, in the last 12 months, Visa earned 36.8 billion in revenue and kept 20 billion of it as net income. This leads the business to produce lots of free cash flow, which is exactly what our super investors love to see. Okay, moving on into the third most held stock by the super investors, we have Amazon. Now, Amazon, as we know, operates a massive e-commerce platform, and that drives most of their revenue, with a fair portion of that also coming from third-party sellers, businesses that sell products on Amazon's marketplace, and then Amazon charges them fees for fulfillment, advertising, and logistics. But beyond the transactions happening on Amazon.com, Amazon also generates revenue through subscriptions, primarily Prime memberships with over 200 million subscribers. Then there's also Amazon Web Services, the profit engine offering cloud computing services to developers and companies like Netflix and Uber and even parts of the US government. There's Amazon's advertising business, allowing brands to pay for premium placement and search results. And they also have an array of physical stores too, including now Whole Foods. Now, funnily enough, the core of Amazon's business is not actually that interesting. The e-commerce platform is massive and dominant, no doubt, but it's quite low margin. For example, in 2024, their North America segment, which includes their retail operations, reported 387.5 billion of revenue, but just 25 billion of operating income. But if you take a look at Amazon Web Services, in 2024, that business generated 107.5 billion in revenue, but kept 39.8 billion in operating income. So AWS is now more important to Amazon than Amazon.com. And it's these higher margin business segments that really entice the big name investors too. The profitability growth in AWS has been rapid, up 74% in the last 2 years. And with Amazon now exploring other high margin businesses such as advertising off the back of their massive e-commerce platform, I think that's what's really drawing in the super investors. In fact, in their latest annual report, Amazon even notes that the increase in North America operating income in 2024 compared to the prior year is primarily due to A, increased unit sales, and B, increased advertising sales. And you can see this trend right the way through their business. In e-commerce, most of their sales come from third-party sellers, where Amazon takes a cut of each sale while avoiding inventory risks. Amazon Prime has shifted from simply a 2-day shipping service to now a massive ecosystem, including Amazon Prime Video, music, gaming, exclusive shopping perks, and fast delivery. All across their business, the trend is towards growing out the higher margin businesses. And that clearly sits very well with the super investors. So that is the third most held stock by our super investors. And then the second most held stock, held by 33 of them, is Microsoft. Microsoft is kind of similar-ish to Amazon in the sense that they too started an original business. For Amazon, it was Amazon.com, and for Microsoft, it was their foundational software in Windows and then Office 365. But they are both now leveraging that foundation to explore other higher margin business opportunities. For example, Amazon has AWS, Microsoft has Microsoft Azure, the Microsoft version of a cloud computing platform used for data storage, AI, security, and online services. When we look at Microsoft Microsoft's financials, their intelligent cloud business, including Azure and cloud services, generated $25.5 billion in revenue in Q4, but kept $11 billion, a net profit margin of 42% versus, say, the more personal computing segment, including Windows, Surface devices, Xbox, and gaming, which had just a 27% net profit margin. The productivity and business processes segment containing Office 365, Teams, LinkedIn, and Dynamics 365. This is another high margin software segment holding a 57% margin. And this is why the super investors are so keen on Microsoft going forward. They've built a very powerful software moat back in the day through Windows and Office, and now they can leverage that to work on these higher margin businesses of the future, their business productivity subscriptions and their cloud computing platforms. It's one of the most profitable and resilient businesses out there. They generate lots of recurring revenue through subscriptions. They have enterprise dominance with big businesses relying on Microsoft's cloud and their software, and they have growth avenues into the future with AI and cloud being high margin businesses that are expanding rapidly. So that's very much the story of Microsoft. And then we get to the last stock to talk about, the company that is held by the smart money more than any other, and no prizes for guessing. This company is Google. Can you see some trends emerging? Google is obviously predominantly known as the other online advertising giant. It's Meta and Google. However, Google's ad dominance is seen primarily through Google search and also through YouTube ads, whereas Meta's is through Facebook and Instagram. So if you turn to Google's financials, you will see the vast majority of their revenue and operating income coming in from ads. In fact, in Q4, 61.7 of their $80.5 billion in revenue came from Google Search, Google Network, and YouTube ads. And here's a bit of a funny stat, 27.9 billion of their 25.5 billion in operating income came from their Google Services business, which is advertising as well as subscriptions, platforms, and devices. So Google is first and foremost a profitable advertising giant, but they too are working on their own cloud business, Google Cloud. However, compared to Microsoft and Amazon, they are a little bit further back, with that segment generating just 9.6 billion in revenue and around 900 million in profit last quarter. So it's a similar idea to some of the other companies. Google is also focusing heavily on AI and cloud computing as they look to be high margin businesses for the future. However, I think the main focus of investors is certainly their monopoly in search and thus their dominance in the highly profitable digital advertising space. And that kind of leads me into the last part of the video, where I wanted to talk about any trends we can see amongst the super investors' most held stocks, and also whether there are some things to watch out for. And I think in terms of trends, there are really two that stand out amongst these companies. The super investors love businesses that show strong profitability and consistent cash flows, and they love a company with a long-term moat, a strong competitive advantage. In every business we've discussed, the balance sheets are rock solid. The cash flows coming in each year are very strong. And you get those situations on the back of a strong competitive advantage. For Meta and Visa, it's their network effect. For Google, it's their monopoly on search. For Microsoft and Amazon, it's their switching mode, also known as an ecosystem mode. And that reminds me of something that Warren Buffett wrote in a Fortune article released about 6 months before the bursting of the tech bubble. He was basically justifying why he wasn't investing in the hyped up internet companies of the time. And he wrote, "I won't dwell on other glamorous businesses that drastically changed our lives but concurrently failed to deliver rewards to US investors, the manufacture of radios and televisions, for example, but I will draw a lesson from these businesses. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. The products or services that have wide sustainable moats around them are the ones that deliver rewards to investors." And I think that's the reason why you see these 5 companies in particular in so many of the super investors' portfolios. But with that said, I do also need to end on a bit of a disclaimer, and that is that while these are the most held stocks by the smart money, it doesn't necessarily mean they're buys at the current time. Very often, with wide moat businesses that have strong balance sheets, you really do need to pay up for them. And in generally euphoric times, like what we're seeing in 2025, these companies are typically quite expensive. For example, just from a quick glance, the only one close to a reasonable PE at the moment is Google at 21, but the others are quite a bit higher, some even into the 30s. And that's consistent with what we're seeing from the super investors at the current time. They're holding these businesses sure for the long term, but you're not actively seeing them adding to their positions. I mean, if anything, you're typically seeing them reduce these positions. But overall, with that said, they are still the 5 most held stocks, the 5 most popular stocks amongst the super investors for 2025. So I hope you enjoyed this video. Definitely let me know if any of these stocks interest you down in the comments section below. And also the last thing I want to just chime in with, if you're interested and want to learn more about the full Warren Buffett investing strategy, including analyzing moats, management teams, reading financial statements, and doing your own valuations on companies in your watch list, please check out Introduction to Stock Analysis over on New Money Education. That is a 7-hour professionally scripted and edited video course that teaches you everything you need to know step by step, talking about that Warren Buffett stock selection strategy. So hope you guys check it out. It is the #1 way to financially support the channel if that's something that you're interested in doing as well. But with that said, that's all I've got for today. Hope you enjoyed the video. Leave a like on it if you did enjoy it, and I'll see you guys in the next one.